Good morning, everyone. Welcome to the Money Matters for the week ending January 24th, 2025. Today's topic is Brr, it's cold. Hope everybody's getting through it okay. So today's topic is actually tax equivalent yield. Now, before your eyes glaze over and you quit listening, we're going to keep this real simple. And this is just a really important thing that a lot of people don't take into consideration. So the question is, what is your actual return on your bank accounts? Um, what is your actual return on your bank accounts? Now, remember, there's CDs, there's savings, there's checkings, those money markets. Those are all taxable investments, which means now that they're actually paying a little bit of interest, at the end of the year, you're going to get a 1099 and you're going to pay taxes on that interest unless it's in some sort of qualified account like an IRA. So keep in mind what you earn is not necessarily what you net. So here's a simple example. I don't get into formulas much in here, but the tax equivalent yield is the taxable yield times one minus your tax rate. So I'll give you a real simple example. Let's say you've got a CD, a money market, some kind of taxable account that's paying you 5%. Now that's by today's standards, that's a good interest rate. But what are you actually going to get? Well, if you're in a 24% tax bracket or higher, which is most of our clients, 24% federal tax bracket, and then if you live in the state of Michigan, that's another four and a quarter. And then most cities impose another percent or so. So you're probably looking at about a 30% tax rate that's going to hit your interest. So we're going to take that 5%. You're going to lose 30% to Uncle Sam. They thank you very much for your patriotism. And you're going to end up with a net return of 3.5%. Now, is that bad? I mean, you're still making money, but it's not a full 5%. And that's one of the things we talk about with our clients is what is your actual realized return after taxes? Because there are other ways you can position assets where the taxes are deferred, mitigated, sometimes not taxed at all. In fact, when you invest in more of a growth portfolio, you defer a lot of those taxes that would typically come up every year for long-term growth, which gets a better capital gains rates tax. So keep that in mind when you're looking at the returns on your cash and you're trying to maximize your dollars, your tax equivalent yield. As always, thanks for watching. We're here for you, your family, and your friends. Stay warm out there and be safe.